What if I told you that one single report released quietly by one of the largest banks on earth just changed the future of gold, silver, and the entire financial system? What if I told you that the London market, the same market that has controlled precious metals prices for over 100 years, is now showing signs of failure that insiders are terrified to talk about? And what if I told you that HSBC has now issued what can only be described as an emergency signal, warning that gold could surge toward $5,000 per ounce, silver could spike to $88, and then the entire market could collapse in the second half of 2026? This is not clickbait. This is not hype. This is not a theory. This is a documented shift happening right now. And if you start this video and stop halfway, you are going to miss the most important part of what is coming next. On January 8th, 2026, HSBC released a research note that immediately caught the attention of institutional investors, not because it was bullish. Banks release bullish forecasts all the time. It caught attention because of its tone. The language was urgent, the assumptions were extreme, and the timeline was short. HSBC analysts stated that escalating geopolitical risks, record global debt, and persistent physical supply tightness could push gold prices above $5,000 per ounce in the first half of 2026. At the same time, they warned that silver could surge toward $88 before experiencing what they described as a deeper correction. That phrase matters. And when banks say deeper correction, they mean violent downside. Before we go any further, tell me where you're watching this from. Drop your city in the comments right now. I want to see how many people across the United States are paying attention to what is unfolding. Now let us start. This is not just about prices going up. This is about structure breaking down. HSBC is not just forecasting a rally. They are signaling stress inside the system that sets global prices. And that system lives in London. The London Bullion Market Association, known as the LBMA, is the backbone of global gold and silver pricing. When you hear the spot price of gold or silver on the news, it comes from London. When central banks move metal, it clears through London. When major banks hedge exposure, it runs through London. And now that system is under pressure like never before. To understand why this matters, you need to understand what has changed. Over the past year, physical demand for precious metals has surged while supply chains have tightened. Central banks have been buying gold at record levels, not because it is trendy, but because confidence in fiat currencies is eroding. At the same time, silver demand from industry, especially energy and technology, has continued to rise. This is happening while mine supply growth remains limited. You cannot print silver. You cannot create gold out of thin air, and that reality is now colliding with a financial system built on leverage. In late 2025, both the COMEX in New York and the LBMA in London experienced technical disruptions during periods of heavy trading. Officials describe them as glitches. Insiders describe them as stress fractures. Systems designed for normal flows were suddenly overwhelmed by demand for physical delivery. This is critical. Futures markets work only as long as most participants do not ask for the real metal. When more people start asking for delivery, the illusion breaks. HSBC analysts have pointed directly to tight physical conditions in silver. They stated that the market is experiencing extreme tightness. That is not a casual phrase. It means supply is barely meeting demand. In some cases, it means supply is not meeting demand at all. Reports from late 2025 showed delivery delays, settlement extensions, and certain silver products becoming unavailable regardless of price. These are not signs of a healthy market. These are warning signs. Here is where it gets dangerous. When prices start rising rapidly in a tight physical market, speculative money rushes in. That pushes prices even higher. That is how you get silver racing toward $88. But when leverage builds too fast, the reversal is brutal. HSBC is openly warning that while the first half of 2026 could see explosive upside, the second half could bring a sharp unwind as positions are liquidated and supply pressure temporarily eases. This is why timing matters more than belief. You can be right about the direction and still lose money if you are wrong about the timing. HSBC is effectively telling institutions to ride the move up and prepare for the exit. Retail investors usually hear about these moves late, after prices are already elevated. That is how people get trapped. There is another layer to this story that most people are ignoring, and it is uncomfortable. From 2012 through 2020, multiple major banks, including HSBC, paid fines totaling over $1 billion for manipulating precious metals markets. This was confirmed by regulators and courts. The practices included spoofing, false orders, and coordinated trading designed to control prices. This is not opinion. It is documented fact. For years, these banks benefited from suppressed prices. Lower prices supported confidence in paper currencies and allowed leveraged systems to function. But something has changed. Physical constraints, geopolitical fragmentation, and debt saturation have pushed the system to a point where control is weakening. When a bank that once benefited from low prices starts forecasting extreme highs, that tells you the pressure is real. HSBC also recently acknowledged that gold and silver inventories in London vaults have reached multi-year highs. That sounds reassuring until you understand what it means. Metal is flowing into London because it is flowing out of other markets. London is becoming a pressure point. Concentration increases risk. And even with higher reported inventories, settlement delays and product shortages persist. That contradiction tells you the system is strained beneath the surface. Now imagine what happens when prices spike. Media attention explodes, retail demand surges, leverage increases. That is when volatility becomes extreme. HSBC has already warned that silver could trade in a wide range between the high 50s and high 80s. That kind of range implies violent swings. Fortunes will be made and lost quickly. If gold approaches $5,000, confidence in the financial system will be shaken. Gold does not rise like that in a stable world. It rises like that when trust erodes. HSBC knows this. That is why their report reads less like optimism and more like risk management. So what does this mean for you? It means this is not a simple buy and forget story. This is a cycle. Cycles have peaks and reversals. HSBC is not telling you to hold forever. They are warning you that the opportunity window may be short. The first half of 2026 could deliver extraordinary moves. The second half could punish complacency. Most people lose money not because they are wrong, but because they have no plan. They buy when excitement is highest and sell when fear is overwhelming. That pattern repeats in every market cycle. Precious metals are no different. The difference this time is speed. The moves may happen faster than most expect. This is also bigger than gold and silver. When major banks openly talk about $5,000 gold, they are signaling deeper issues. Debt levels are unsustainable. Monetary credibility is weakening. Volatility is becoming the norm. Precious metals are simply reflecting stress that already exists. I'm not here to tell you what to buy or sell. I'm here to tell you to pay attention. Read the reports. Watch the data. Understand the timeline. Know where you will take profits and where you will step aside. Do not let emotion decide for you. The London market is not officially dead, but it is no longer stable. The LBMA system that dominated pricing for a century is showing cracks that cannot be ignored. HSBC has given a roadmap, whether intentionally or not. $5,000 gold, $88 silver, and then a correction that will shock those who assume the rally never ends. This moment will separate preparation from panic. Some will benefit, others will learn the hard way. The clock is ticking. Drop a comment and tell me what you think. Are you positioning now, waiting patiently, or staying on the sidelines? However you respond, make sure it is a decision, not a reaction.